see if, make sure people joining here. There's a few in here. All right, I'm going to go ahead and get started. Good afternoon, everyone. My name is Dave Hatton. I am with First Midwest Financial Network, financial consultant. Thanks for joining us this afternoon. We have our disclosure slide up here right now. Just goes over a couple things that you need to be aware of. That the products we talk about are not from the bank. They're actually provided by LPL Financial. We are dual employees and represent First Midwest Bank as well as LPL Financial in all of our dealings. Thank you for joining us. And we did an update with one of our providers back in October, and since then a lot has happened. Obviously, we had an election, and we started the process a couple months ago to do a new update because there has been so much going on. We started that in the first part of January, and since that time, there's even more going on. And as you'll probably you've probably heard of a couple of no-name stocks and companies out there like Gamestop and AMC and something we haven't used in probably 20 years, Blackberries. Those have been, those small little companies have disrupted the world within the markets, and you're probably wondering why. And we're joined today by Scott Brown. Scott is a senior analyst and head of technical strategy at LPL Research. He's been with them for about 5 years out of the Charlotte office. And he's going to go through LPL's 2021 outlook. And without further ado, I'm going to turn it over to Scott and let him go over what LPL is looking at for 2021, as well as we'll cover your questions as we go along. If you have any questions as we go, please feel free to raise your hand or put in something in the Q&A, and I will interrupt Scott, and we'll get those questions answered for you as we go along. Scott, go ahead. Over to you.
Great. Sounds like a plan. Thanks so much, Dave. Good afternoon, everybody. I'm excited to be with you all and speak to you a little bit about what LPL Research sees happening in 2021. So if we go to the next slide, you can see this is the infographic from our outlook for 2021. It's our big flagship publication that we do twice a year. We'll have a mid-year review coming out in about June or July. But the real theme here is this kind of restarting your engines. And so you'll see some of that. But 2020 was certainly a very interesting year. We're going to touch on that really to begin the presentation and kind of set the stage for just what exactly happened in 2020. But obviously, after coming to a complete halt, we're restarting things up. So if we go to the next slide, we can see we just got a little tribute here to Regis Philbin. We did lose him in 2020, but a good quote that I think really embodies last year. I'm involved in the stock market, which is fun and sometimes very painful. And we got both of those emotions in big doses last year. And just want to, again, set it in context for just how historic what we saw last February and March really was. So on the next slide, you can see this is a history of some of the fastest bear markets ever for the Dow Jones Industrial Average. We use the Dow because we've got history all the way back to the 1800s. And you have to go all the way back to the 1800s to find the previous record for the quickest bear market ever. The shortest amount of time from an all-time high to down at least 20% was 36 trading days. That's, about a month and a half. And that was the previous record from 1896. We did that in just 19 trading days, reached it on March 11th of last year. So again, your eyes did not deceive you. We truly were in unprecedented times for just how quick that drawdown was. You can see where we ended up, though, on the next slide. One thing that's really, really interesting, the market was down over 30% year to date at the March lows, minus 30% on your statement, minus for a year to date return. Never before has the market, the S&P 500 we're looking at here, been down 30% year to date at any point, and we were certainly advantaged by the fact that it happened early, but it's never been down 30% year to date and finished positive whatsoever. Never done that in the history of the stock market. Not only did we finish positive last year, we finished with an over 16% gain. That's basically double what you do on an average year. So it's just another historic wild ride. Now, while that was very unique, one thing that was a little bit more similar can be seen on the next slide. And this is one thing that kind of helped us keep our cool while it was obviously very scary. And frankly, by the time the market had bottomed, you were just really starting to see the effects in your everyday life. But while a small sample size, this stock market toll that the pandemic had was actually very similar to other 50-year flu outbreaks. You look at the 1918 H1N1 pandemic, 33% loss. 1968, a 36% loss. Well, this was right there in the middle. So history doesn't repeat itself, but it often rhymes, Mark Twain said. Some similarities at least there. And so on the next slide, you can see this kind of very simple infographic, but really a lot of opportunities for this vicious cycle of greed, buying at the top, selling at the bottom, and repeat until broke. And at LPL Research, we are certainly trying to outperform, to try and find what areas of the market are going to perform best. But I think at the very least, one of the most important things we can do is try and help people avoid this vicious cycle, because again, a lot of opportunities to really get scared, really just gives you the message that it's important to stick with your investment plan through thick and thin, because it can be really hard to figure out exactly how things are going to play out and how quickly they could play out. So if we go to the next slide, and it's just an introduction, we can go on and go to the one after that. But we want to talk about the economy and also this kind of perceived disconnect from the stock market and the economy, because this isn't a new phenomenon. I think people are still looking at unemployment that's close to 7% and a stock market that's been at all-time highs for months and have trouble reconciling those. But this is a cartoon from all the way back in 1928, just showing this isn't exactly a new phenomenon. And if we go to the next slide, you can see it really in more recent history. This is looking at the 2008 to 2010 financial crisis. These lines are clearly correlated. What we've got here in blue is the S&P 500 price. You can see that gigantic drop we had there. And then you've got the unemployment rate, which is flipped over. So as that black line is falling, unemployment is getting worse. And as it starts to rise again, that's the unemployment rate declining. Clearly, stocks in the economy are connected. The stock market and unemployment are very correlated. But if you look to the gap where they both bottom in 2009, that gap is really important, because that gap looks like a blip on this screen, but it can feel like an eternity in real time. That's about 7 months in between those 2 points right there. The S&P 500 bottomed in March of 2009, very similar to bottoming in March of 2020. And in March of 2009, the unemployment rate was at about 8%. Over the next 7 months, the S&P 500 gained 60%. It V-shape off the bottom, and it never looked back. We've never seen those levels in the S&P 500 again. But over those 7 months, while stocks were gaining 60%, unemployment went from 8% to 10%. So every single month that jobs report came out, unemployment was getting worse and worse. It seemed like things were getting worse and worse in the economy. Now, unemployment, of course, turned. It eventually started to catch back up, and everything, over the long term looks very correlated. But it's just important to keep in mind that stocks always lead the economy. And when you're in that little window, it can feel like there's a complete disconnect, but this is very, very normal. Going to the next slide, we can quickly see that, this is how the market is officially defined by recessions. You can see that on average, the stock market actually bottoms 5 months before a recession ends. And what that graph doesn't tell you is that that's when the recession officially ends, but you usually don't even get the official word that the recession is over until 3 to 4 months after that. We still have not officially declared that the recession we're currently in is over, even though the stock market bottomed all the way back in March. We think it actually could be over now, but even if they tell us that, maybe they tell us that and they'll say, hey, the recession ended in October. So just to put that in perspective, there's always a big disconnect between some of this economic data and some of the stocks. Now, talking about the unemployment rate, how long could it take to get unemployment back to where it was previously? Well, if we see on the next slide, you can see the last 10 recessions have taken on average about 30 months to reach the previous employment peak. But there's a really wide dispersion there, and that long green line is 2007. And it took over 6 years for unemployment to really come back. We've gotten back about half the jobs now. And so that's a really quick, good start. That's very different than what we saw in the great financial crisis. But closing that last little gap is going to be hard until the virus is really completely clear. It's going to be very dependent on vaccines. We've got a slide here in a little bit that's going to show the kind of K-shaped recovery, but we all know that lower paying service level jobs have been severely affected. The unemployment rate at that level, and for those industries, travel and leisure, hospitality, it's very, very high. And frankly, there isn't a lot of reason to think it's coming back in the next month or two. And the kind of longer that it takes for that, for those people to come back, you do create a little bit of friction that could make that last mile on unemployment take a little bit longer. But all in all, around 30 months seems kind of reasonable to base case, maybe even closer to 2 years, but it's really going to depend on how the next 6 to 12 months play out with the vaccines and things like that. Now, that next slide is, in fact, the K-shaped recovery. So just touching on that point, you can see here, it's the high wage unemployment rate versus the low wage unemployment rate. And what this essentially shows is that all the high wage unemployment jobs have really come back. Meanwhile, the low wage unemployment rate has popped up and really not improved at all, unfortunately, as we would expect. Now, of course, stocks, the economy, always disconnected, but there is a reason that stocks are able to look ahead. And the most important one, if we go to the next slide, it's just vaccines are here. Vaccines are in people's arms. I know doctors, nurses, both my parents have now had their first dose of the vaccine. I'm sure we all are starting to know people that have had their vaccine. So they're literally going into people's arms. That's great news. And the market was pricing in this as it happened. As these vaccines were going through trials, phase 2, phase 3 trials, the market was kind of looking ahead, pricing that in, having that glimmer of hope, and it didn't take much. And it was able to run with that. So that's absolutely part of the reason that stocks were able to rally so strongly in the second half of 2020. But the second reason, and it's kind of a two-part reason, is policy. And this is really important because policy is going to play a big role in our forecast for 2021. So if we go to the next slide and we can really skip past just that introduction, policy encompasses two main things to us. First off is monetary policy. And monetary policy can be a little bit hard to understand because you don't see it in your everyday life. But when we're talking about monetary policy, we're talking about the Federal Reserve. And we're talking about what they're doing to help the economy. And again, this is kind of a wonky graph, but what you're seeing in the bottom panel is what's called M2 growth. And it just shows the amount of liquidity that's in the system, essentially. And that's what the Fed is there to do. They're there to backstop the banks. You don't interact with the Fed because you don't necessarily, you aren't a financial institution, but it's really important for banks because the Fed is the backstop for banks. And so if the Fed, essentially what they did was through various policies and programs came and told the banks, go out and lend to your customers, to your clients, we've got your back. And it just cannot be understated how important that was and how strongly they came in. And you can see that liquidity, that injection of cash that the Fed put in the system, it was always there, but it just absolutely skyrocketed at the beginning of 2020. And so that was hugely important. As we see on the next slide, the implication for 2021 is that the Fed isn't going anywhere, that all of those programs, all of that cash, the Fed has made it abundantly clear that they are absolutely going to be there. That's why we've seen high yield and credit markets just instantly stabilize. And now we see high yield spreads and some of those measures of companies' balance sheets and health. They're basically back where we were in January before anyone knew about coronavirus. The Fed has made it very clear that they are not going to they're going to do everything in their toolbox they can. They're not going to let the economy falter. Now, the second part of policy, which we see on the next slide, is fiscal policy. Now, this is what you're going to see a little bit more in your day-to-day life, because now we're talking about bills that Congress, that the White House get together and actually pass specific programs, the most notable of which was stimulus checks and things like that. But again, to their credit, despite all the divisions in Washington throughout 2020 and certainly still now, they came together and there was a lot done. You could argue, looking at this graph, other countries might have done more, But what we're seeing here is the orange bars is the fiscal stimulus in response to the pandemic. That blue bar is all of the fiscal stimulus following the global financial crisis. So when you hear about the auto bailouts and the bank bailouts and everything else that went into the giant, just everything that was terrible about 2008, 2009, the fiscal response, the money that Congress and the White House put into the system to help combat the pandemic in just a matter of months dwarfed everything that was spread out over those 2 to 3 years. And so that was another big reason why companies, we kept this from spiraling into something that could have been a lot worse. Because I think it's important to remember, we really didn't know how things were going to play out, and people were really, really scared in March and April. We were getting questions from advisors and clients that was not just, are we looking at the Great Recession? It was, are we looking at the Great Depression again? And so that just really tells you where stimulus was. But it's important to kind of give credit for the fiscal policy and how much they helped some of these things not spiral into something that could be worse. We have a health crisis. The health crisis and dealing with it is kind of its own animal. Vaccines are the only thing that's going to fix that. But from a financial crisis, we really helped it not become too much more of that. And so that's very key for the stock market. Now going forward to 2021, the next slide, this is a big question. The country's basically 50-50, but a big question we've gotten from advisors and clients is worries about the Democratic sweep. We didn't really, to be honest, our base case was not for a Democratic sweep. A lot of people, us included, did not think that Georgia would send 2 Democrats to the Senate, but we do have, you could call it a blue wave, maybe a blue ripple might be a little bit more appropriate, but there's a 50-50 split in the Senate between Democrats and Republicans, but Kamala Harris, being the vice president, gets the tiebreaker. And so technically there's that slim Democratic majority. Should this scare markets? Probably not, looking at the history of when the S&P 500, when Democrats have controlled both the White House and the Congress. Those average returns that you see there, 9.1% higher, about 78% of the time, are almost right on the dot, the long-term historical averages in all instances. Similar messaging on that next slide. The first year after a new Democratic president with a blue wave or coming in with a Senate and House majority, the S&P 500 index year, that's just that following 1 year, on average, higher by about 12%, higher 75% of the time. Those are pretty close to average and slightly above on the average return. So we do think that that's important to take note of. The concern is taxes. We can see that on the next slide. Yes, taxes could go higher. It's important to remember that very, very slim majority, it just takes one defector on any issue to really take things off the table when it comes to some of the more aggressive proposals that you might hear with taxes. But taxes can be important for the market, and the proposed Biden tax would be the largest since LBJ. This is broken out a little bit further on the next slide, where we look at some of these individual tax groups. The one the market is most concerned with is going to be over there on the left. Corporate taxes. Earnings are the long-term driver of stock returns. If you take more earnings from companies, then they have less earnings. And so in theory, that does present a direct potential haircut to the S&P 500. The thing that's we think is important to note here is just that proposed 28% tax rate is still well short of what it was prior to the 2017 Tax Cuts and Jobs Act. That was at 35%. So just the baseline proposal is really splitting the difference. And again, it really remains to be seen if that's going to happen, because it just takes one defector that says, hey, maybe raising corporate taxes while we're still technically in a recession isn't the best idea in the world. And suddenly that's off the table. But all in all, our messaging is more, and I think this has been seen in the market's reaction to both the election of Joe Biden as president, as well as the Georgia runoffs. Markets kept on trucking higher. And we believe that that's because on the next slide, you can see any taxes increase or any potential for tax increase is likely to be offset by more spending. Again, you could have more taxes, but that fiscal stimulus for an economy that could desperately use it in some areas has really been an important focus. That's why we think we've seen more cyclical areas of the market. These beaten down areas, small caps have been rallying very, very strongly, especially in the final 2 months of 2020. That's because small caps and also energy stocks, financial stocks, they're more tied to the health of the economy. And so this spending that has the potential to help the real economy a little bit more helps those companies and did help those companies play a little bit of catch up. But all in all, our messaging is just that any tax increases are likely to be offset by spending. Stick to your investment plan, and most likely concerns about Democratic sweeps are a little bit overblown. On the next slide, we've got a few specific winners under a Biden presidency. As I just mentioned, the cyclicals tend to do better historically under Democratic presidents, but there's a few other things on there as well. Renewable energy, that's been a big one as the market was kind of looking at the possibility of a Democratic presidency. Those stocks have been rallying strongly. On the next slide, and this is a very busy one, but it's just important to remember, I think, that policy isn't everything. Policy, when it comes from the big macro perspective, was hugely important, and we think will be very important for the markets, what the Fed does, what Congress does. But on a sector level, it tends to matter a little bit less than people think. In 2016, the overwhelming consensus for what would do well after President Trump won the election was energy and financials. We probably would have said it too. It certainly seems reasonable that those areas that have been hampered by regulation under a more deregulatory regime would do a little bit better. Unfortunately, policy is one thing, but the economics of those areas don't go away. And during the course of President Trump's presidency, and this goes back to the election date, so it includes that initial bump, and right before the election is when this data is through. But the energy sector lost 55%. And the financial sector, and that's lost, that's cut in half. It literally lost over half its value. And the financial sector returned 23%, which was less than half of the S&P 500, the broad market's return of 58%. So again, perfectly reasonable assumptions, but it just tells you that policy is not everything. You still have to think about the underlying fundamentals of those businesses. Now, what does all this wrap up to? On the next slide, we can just see our baseline 2021 economic forecasts. For 2021, we see the U.S. economy bouncing back and doing about 4 to 4.5% in GDP growth. Emerging markets, which actually performed the best in 2020, they barely declined, minus 0.7. Not only did they decline the least, but we see them bouncing back the most with a 5 to 5.5% growth in GDP. And then developed ex-US, what we mean by that is basically Europe and Japan. Those areas of the market were frankly performing the worst. If we look back to what, pre-COVID 2019 levels, they were hurt the most by COVID in 2020, and we see them bouncing back the least. So that really just kind of wraps up and is the reason when it comes to tactical models and stocks, and we're going to talk about that here a little bit, but a reason why we continue to favor emerging markets over foreign developed markets, but we still like the US. It's just kind of right there in the middle of the pack. Now, if we go to the next slide, we're going to talk about bonds and kind of get into portfolio implications a little bit more. What this chart shows, and I know it's a little bit busy, but anytime you see a sharp drop to the bottom, you see this chart bounce back. And what this is showing that anytime we've had a large decline in US Treasury yields, they've turned higher over the next year. And specifically, anytime we've had a 125 basis point decrease in the US 10-year Treasury yield, like we did in 2020, we've seen on average about a 90 basis point rise over the following year. And that, if we go to the next chart, seems to be playing out here. You can see, look at 2019, rates were already falling, and then 2020, they just absolutely fell off a cliff. We made new all-time lows. The previous record for the 10-year Treasury yields all-time low was about 1.36%. We briefly traded to about 50 basis points multiple times last year, but we've now seen a bottoming pattern. This is kind of what I do is I look to patterns and charts and things like that for our team. And we've seen this bottoming pattern play out. And just here in the past couple of weeks, we've broken out higher. Yields are now actually above 1%. They've held above 1%. And consistent with that theme on the previous chart, we think they're going to continue to rise and push their way back up to the previous record lows. I think 1.36 is kind of the first stop, but we think there's actually more of an upside surprise here, and probably more likely that we break through and maybe we even go above 1.5%, that we go back below 1% for a considerable amount of time. So that doesn't really paint a great picture for fixed income in 2021. It's one of the key reasons that we're favoring stocks over bonds, because on a fixed income basis, what you have are two main drivers of return. It's your coupon, that 1.1% you're getting right now, but also the change. And because prices and yields move inversely as interest rates continue to rise, that hurts the return of your current portfolio. And so it just leaves, all in all, our base case outlook for fixed income returns to be about 0 to 1%. We, I think, basically be happy to get anything. Wouldn't be surprised to have returns close to 0% for diversified core bond portfolios. The good news is, and the reason that we advocate continuing to hold fixed income can be seen on the next slide. It's what they do when you have equity market declines. High quality bonds, time and time again, show up when we have corrections in the S&P 500, especially treasuries. You can see the Barclays aggregate, which is a little bit more diversified mix of high quality bonds, on average has returned 1.7%. Anytime we've had a 10% correction over the past decade, treasuries have done even better, 4%. So they still have a very important role in your portfolio. The best thing that fixed income investors really can hope for is rising rates, because while you might have to feel a little bit of pain, a little bit of low returns over the next year or two, if they get to more normalized levels, that means higher returns over the long term. And so we think that rising interest rates would ultimately be a good thing for investors. Now let's go to the fun part and talk about stocks. The big key for 2021 is earnings rebounds. When we're talking about taxes, I mentioned that earnings are really the long-term driver of returns. We had an earnings decline last year. We were in a recession. That makes total sense. The market was pricing that in. The market was looking ahead. But if we go a couple of slides ahead, we can kind of see that the return of earnings growth may be only one quarter away. You can see those declines there for 2020. But in Q1, we're expecting to be positive. And that Q4 estimates are rolling in right now. The chart shows that it's going to be negative. It probably is going to be negative. But companies have been blowing earnings expectations out of the water. Maybe people got a little bit too pessimistic on how much corporate America would be affected by the pandemic. We're probably not going to get to earnings growth this quarter, but we have a chance to be very, very close to flat, which, again, you can see is about minus 10% was the baseline expectation coming in. That's really, really good. And then as we get to Q1 and Q2, we're going to see monstrous, historic earnings growth. Again, part of that is somewhat artificial. Some of it is really just getting back to normal because Q2 of last year was so terrible. But all in all, that we are going to see some monstrous earnings per share growth that will most likely be in excess of price return basis and then kind of play catch up for this year. Now, if the market's looking ahead to 2021 earnings or was doing that in 2020, it seems reasonable that we might want to look ahead to 2022 earnings. The good news is if we go to the next slide, we can see that 2022 earnings over on the far right are predicted to grow almost as much as they will this year. So if people do start to look ahead, that should be perfectly fine. We don't think that that represents an area for a big drag on the market. Going to the next slide, we just want to reiterate here that new bull markets historically have built on strong first year gains. We've had a historic run here, but in every case, looking at these back to 1970, we look at anytime we've had a 30% decline in the S&P 500, every time that second year added to the first year gain. So even though we've had big gains, we had big gains in all these prior instances, and we were still able to add to them. Another statistic that points to that is the big end of the year rally. If we look on the next slide, November and December, we actually had the best return for that 2-month period ever anytime we've had a strong November and December return of over 10%, the following year return has been higher every single time with an average return of 18.1%. So again, it just tells you don't necessarily have to think that just because we've had big gains, there aren't more gains to come. Looking at internal data, which is another thing I do, we want to see if the market's healthy. We can look on the next slide, and this just kind of tells you how broad the bounce back is. One concern people like to look for is maybe these, you hear a myth or you'll hear people saying, well, the S&P 500 would be negative if you took out these couple of stocks, or not all the stocks are participating. Nobody can say that right now. Right now, we have 91% of stocks in the S&P 500 in what we would consider uptrends. That's the highest reading since 2013. And for small cap stocks, it's actually the highest reading since 2004. And our messaging here is very simple. These kind of big readings are not only something that you don't find at market tops, you typically find them at the beginning of big market runs. 2013, the S&P 500 returned 32%. You can see the other times we've been here, coming off the 2009 lows, coming off that correction we had, or the bear market, close to bear market we had in 2011. These are things that typically happen when markets are just starting to get going. Now on the next slide, again, we're trying to use data and analysis, but here's the thing from Anchorman. They've done studies, 60% of the time, it works every time. It's always important to pay attention to what's going on now. And we could be due for a break. If we go to the next slide, even if we still expect gains in 2021, it's important to recognize that they probably aren't going to come in the same straight up fashion that we saw last year. As you can see, we had one of the best starts to a bull market ever. But if we look at the second and third previous best starts, things got a little bit choppy around the year to year and a half mark. But again, back to that previous chart that we showed with year two, it always finishes out positive. It just might involve a correction or two. We really didn't have much of that in 2020. A few risks, if we go to the next slide, we think sentiment could be a next risk. And obviously this feeds into some of the things that Dave mentioned with Gamestop. But this is kind of a technical framework that we use here. And we actually look at sentiment from a contrarian perspective. And so what we actually like to see, what I as a technician like to see, is when the market trend is positive, but the market sentiment is really negative. That's that top right quadrant. That's actually the most bullish. When there's a wall of worry, when sentiment and everybody doesn't like stocks, that's usually when stocks do really well. When stocks do a little bit worse is when everybody's really excited about stocks. And so this is not, we're not calling for a market top. It's still a positive bias, but just important to realize that as everybody's kind of realizing the vaccines are out there, that we're actually into 2021, we can see the light at the end of the tunnel. Everybody who was very scared, we've gotten through the election. We've got vaccines now. It's just important to realize that historically, the market might be a little bit, still a positive bias, but not quite as bullish of an environment as we were in last year. Now, the other obvious implication here is, of course, GameStop. Is sentiment too frothy? Do we think GameStop is a sign of something especially worrisome in the market? All in all, no. We think that what we have is a very unique situation with a couple of stocks that have, retail money and things like that. But the most important thing to remember is that GameStop is a very small company. And when you have a very small company, low shares outstanding and things like that, it's very easy to manipulate the market. If all of these people decided to get really, really excited about Apple or Microsoft stock or something like that, they could not nearly affect the price as much. We don't think that it's really a sign of excess in the market. It's more of a quirk. It's been a fun sideshow to watch, but all in all, we don't think that it represents something deep-seated in the market. We think valuations are frankly very reasonable. The companies that make up the biggest weights, the real tech giants like the Apples and Microsofts and Google, have some of the strongest free cash flow in the history of stocks, frankly. And it's just a very different environment than the dot-com bubble. Again, it obviously has some similarities. It's just important to remember that at that point, what was being traded and bid up and had no earnings was all of the most valuable companies in the S&P 500. It wasn't just a couple of really, really small stocks. And so we're going to continue to monitor the situation. But right now, we just don't view it as a broad market risk or really a sign of anything ominous to come. If we go to the next slide, we'll just wrap up. I don't know, we want to make sure we've got time for Q&A, but here's our U.S. stock market forecast. Our baseline S&P 500 fair value estimate is about 3,850 to 3,900. Now that's only a little bit above, but as earnings, I mentioned the earnings expectations for Q4 really, really improving. That means that we're likely going to be raising our earnings expectations even more. For 2021, our baseline was 165. That's getting back to even. That's getting back to what we did in 2019. But if we raise that, we'll likely be raising the fair value estimate for the S&P 500 to a little bit more. And nevertheless, we would not sell just because we were a little bit above. Markets tend to fluctuate. But all in all, we see mid-single digit returns coming in for stocks. And then you can see the 10-year Treasury yield on there as well, rising up to that 1.25 to 1.75 level and potentially pressuring bond returns. Finally, getting a little bit more specific on how we're allocating assets on the next slide, you can just see a few of our favorite sectors here. We continue to really like technology and some of the growth. We've seen those kind of pause a little bit in the second half of 2020 as people got really excited about the economy reopening. Small caps were the leaders, financials and energy were the leaders. And in January, we've seen a little bit of a move back towards technology. We think that that's kind of the baseline expectation for the first 6 months is you're just going to have this flow, this kind of yin and yang where the market's going to get really excited about things for a little bit. And then you might have to go back to the safer plays. What's been consistent throughout, though, is that stocks have been going up in very, very defensive areas of the market like consumer staples and utilities have consistently been the weakest. And so that's been our messaging. You can see those are down there in the bottom right, but utilities rated very negative along with real estate as well, which does have some fundamental pressure. I'm working from home actually and have been for about 10 months now. And so we think that some of those trends, especially in bigger cities, could pressure real estate. But all in all, that's just kind of our messaging is we still like growth stocks, but we could anticipate neutralizing that in favor of value. But we see stocks going higher. And then internationally, really continue to prefer emerging markets. We like the demographics there and the growth that we see in China and India very much versus Europe and Japan, where demographics are a giant headwind to stocks and earnings for companies over there. So that's the last slide. If we go to the next slide, you can just see that the journey continues. Just please know that LPL Research is there to help guide you in your investments throughout all this. We'll continue to monitor the situation, but we're very excited for what 2021 has to bring. And certainly while we see stock market returns that could rival what we saw in 2020, we're hoping that the path, both personally and in actual volatility terms, is a lot smoother than we saw last year. So Dave, I'll let you open it up for Q&A. Happy to take any questions.
Appreciate it. Thank you, Scott. While we're waiting on them to come in, I have a couple I'll start off with. First of all, when you look at the dip, and you alluded to this to quite a bit, but back in March of last year, we saw the drop in the economy. It started to come back. How close are we now to pre-COVID levels?
In terms of the economy?
Correct. GDP, for example.
Yeah. The GDP numbers, came in pretty strong. I think they came in a little bit better than expected. That tends to be old news, but our baseline forecast is that 2021, we're going to see a pop back. So we're going to see probably one of the better yearly GDP readings that we've seen in the past decade because we're growing from that declined level last year. But all in all, I think we see us bouncing back more long-term to that 2 to 2.5% range. And we're in a good place. Like I said, it's not been officially declared, but we think we're technically out of the recession. When the NBER comes out and says, hey, the recession is over, we don't know exactly what that point in time will be, but we think it's going to be at some point here in the past right now, if that makes sense. And then I mentioned the unemployment rate. That's going to be really key. We're only about halfway back there. We've gained back about 50% of the jobs that we've lost. Unemployment spiked up to 14.9%. We're a little bit under 7%, and we were under 4% prior So we've got a little bit ways to go, and I think that might be a little bit tougher route. We could be out of the recession, but we still might have that last 3 to 4% that's going to be tough to get back until things are just completely back to normal, until we're back all eating in full restaurants, going to concerts, going to football games, and things like that.
Okay. And you were talking about unemployment and the K-shaped recovery. Right now, I think the Biden administration is wanting to do about a $1.9 trillion stimulus plan. We've already had several trillion that have been put into the economy. How much of this stimulus can actually move to, for lack of a better way to put this, replace the income that would normally have been earned by the lower part of that K?
It depends on how it's targeted and how the programs get put out there, but it can frankly do a lot. Even though that definitely, the subset, and there's certainly a lot of people that are still hurting from this. This has been a very strange recession. We've never had a recession where outstanding consumer credit card debt actually declined. I saw an article the New York Times did, by some measures, personal wealth has actually grown for 50% of the people in this country. And so it reiterates that K-shaped recovery. On a more personal level, mortgage evictions and things like that, it's basically about providing a Band-Aid. That's what the policy is.
Mm-hmm.
It's providing a Band-Aid until we can ideally get back and they can actually have jobs that, involve people being masked and things like that. So I think it's all in all, it's done a good job and it can hold us over. We just hope it doesn't have to do it for too much longer.
All right. And last question I have, I'm still waiting. There's no questions coming in from the group at this point, but last question I have, all this stimulus and with a little bit of slack overall in the economy, how much pressure is that going to put on inflation? And could that possibly force the Fed's hand to raise rates a little earlier than they had anticipated?
It's the million-dollar question and the thing that everybody should be paying attention to. I think people have been kind of incorrectly looking for runaway inflation from monetary policy for a long, long time, to the point where they've almost given up on that. But I think what's underappreciated has been the fiscal stimulus impact on inflation. Monetary policy can only do so much, but when you literally give checks, and in some cases, some big checks to people, and in some cases, it wasn't always targeted, those people that have gotten richer, people can't spend the money when they're cooped up at home. We see commodity prices really bubbling up. We've seen inflation expectations. When we look at market inflation expectations, they tend to move with 10-year Treasury yields, but 10-year Treasury yields, like that chart we showed, have not gotten back to where they were pre-COVID. Inflation expectations have blown through where they were pre-COVID. And so I think there's some signs of that bubbling up, and it's going to be important. A couple of months ago, even, people weren't expecting the Fed to raise rates for 3 to 5 years. We still think, there's no chance the Fed is raising rates in 2021, but could it be sooner than 3 to 5 years? I think there's a good chance, and it could be because of that. Wages are the biggest one to watch, because you're not going to have real inflation if you don't have wage inflation, but it's something to watch for sure.
Okay. I do have a question here. States and cities are suffering from a lack of revenue. Obviously, not a lot of sales tax and different things coming in. How concerned should we be?
We're not too concerned with the muni market. I think, frankly, that's one area that it goes underappreciated, but both sides of the aisle recognize that you can't have municipalities just going bankrupt. It simply can't happen, and we fully expect that those things are going to be band-aided over. We've seen spreads. We look at the spread, basically the coupon that municipalities have to pay relative to treasuries. It's returned to completely normalized levels. And I think that just reflects the market expectations that we don't see delinquencies, and we expect the Fed and Congress to basically step in as needed. Again, Congress recognizes some of the headline articles and things that cause worries when you see Congress out there rejecting the idea of giving these huge inputs to municipalities and states and things like that. That usually comes down to municipalities and states that had budget issues prior to COVID. And obviously, these tend to be more Democratic leaning areas, and the Republicans basically come out and say, hey, we're going to cover you for what's COVID related, but we're not here to rescue you for problems that existed prior to COVID. But all in all, we think that the municipal market remains favorable and that the allocation immunities basically comes down to your individual tax situation, but we wouldn't be shying away from them or anything like that.
Okay. Had one other question. I'm going to actually respond to that here in just a second. We're not going to necessarily provide the slides themselves, but we are going to send a copy of this out to everybody. We've recorded this session. Probably should have made that clear beforehand, but we're going to go ahead and send out the link to this to everyone as well. That was pretty much all of my questions. And unless anyone else has any additional questions, I'm going to ask that we just wrap it up here. One real quick shameless plug. We're going to be doing two webinars coming up here in the next 3 or 4 weeks. One, we're going to do getting your financial house in order. I'm going to have another on how to Roth conversions and how they can assist you in your retirement planning. So I hope you can join us then. Thank you all very much for joining us. Thank you, Scott, for your time and your expertise and all the wealth of knowledge you've shared with us. So thank you all. Have a great day. And if you have any questions, feel free to reach out to me as well. Bye now.
Thanks, everybody.